So if I were to ask you, what is the infinite banking concept? What would you say? I bet I could guess what most of you would say. You see, I get asked this question all the time. People say, so tell me, what is the infinite banking concept? And it's a very simple thing that I tell them. The infinite banking concept is a process of you taking back the banking functions in your life. Now that might be too much to digest. You might think, well, I don't really know what that means. Well, think of it this way. If you are giving up the banking functions in your life, what are those things? Well, first off, you're taking your hard-earned money that you trade hours for. The most valuable resource you have is your hour, and you trade that for a monetary value. $100 an hour, $25 an hour, whatever it is. You take those paychecks that you traded time for, and you give up control of that money to a bank. Almost every one of you deposit that money in a traditional bank account. Now, let me ask you a question. When you put your money in a bank account, does the bank take your money and put it in a vault with your name on it? No, no, no. The bank takes your money and makes it work for them. It puts it into motion. All banks' money is in motion. They take your money, your deposit, and they lend that money out at a higher interest rate than what they're paying you. And the result is they make a spread. So now let me repeat. What is the infinite banking concept? It is the process of you taking back that function right there. You are no longer going to need the bank for any of the things that you need to finance. You are going to be the bank, and you are going to make payments just like you do to their bank back to your private banking system. So the infinite banking concept is a process. It is not a product, because I'm going to guess most of you, when I asked you what it was, you said, oh, it's a whole life insurance policy. You went right to the product. Well, that's what we're going to talk about today. We're going to talk about the process called the infinite banking concept. So let's dive into the infinite banking concepts, the process. Again, it's you taking back the banking functions in your life, and the way to do that is simple. You need to change one thing, and that is where your savings goes first. Because you can't be your own bank if you're depositing money in their bank, because the bank is the one who's making your money work, and the bank is the one who's making the spread, not you in the traditional banking system. There is no bank out there that you can take and make a deposit to, and then they pay you a higher interest rate than they would charge you on a loan. It just doesn't happen. If they're paying you 2% on your money at the bank, then they're charging you more than 2%. True or true? Of course, yes. And in the middle, they're always making a spread. And they just keep doing this over and over and over again. And in doing so, they make a whole bunch of money. So wouldn't that be really cool if you could do what a bank does? Because by the math, according to BauerFinancial.com, banks make 400 to 1,300% more than you do on the money you deposit there. So what business do you want to be in now? Well, probably the banking business. So let's start with, what does that look like? Well, let's just start with what you do with money. I already said this. You deposit your money, you take your hard-earned dollars, and what do you do with them? You take them and you deposit them in a bank. And then the bank pays you interest. And then when you need money, what do you do? What do you traditionally do? Let's talk about a car. When you need money for a car loan, what do? You call a bank or a finance company, and you go to them and you do all the paperwork, fill out all the applications, they pull your credit, and maybe they approve you, okay? So now you're approved. So now what they're gonna do is they're gonna lend you money for that car you're going to purchase. So they're gonna take the money, they're gonna lend it to you, it's gonna go pay for the car, and now you have a car, but you're gonna make monthly payments now. You're gonna just every single month make a payment or two to that finance company that gave you the money for the car. Now that payment includes interest and principal over a period of time. As of right now, if it was a car loan, you're probably going to pay 6 to 8%. Okay, that would be the interest rate. Now, do any of you, just asking for a friend, do any of you have a bank that pays you 6 to 8% on your money?
What? Bro, what are you talking about, man?
No? I didn't think so. Haven't heard of any of them out there. But they charge you that much. So imagine this. Let's be the bank. Let's apply the infinite banking concept. First off, you would change where your money went first, and it would go into an account, which we'll get to. That's that product I mentioned earlier that you all think is the infinite banking concept, which it is not, because you can do what I'm teaching you, this process, without the product. You can do it with anything, including a bank account. It's just not very efficient. So now you changed where your money went first. This money no longer went to a bank to sit there to save up for the car. It went over into a different account that pays you guaranteed interest and dividends and grows tax-free and a bunch of other things. So that's not important. We're going to get to the product in a second. Now, you're going to take a loan from that account. So you're going to take a loan from that account. You're going to then pay for the car. Now, remember, this is no different than what you did before. You were taking a loan from a financial company or a bank to buy the car, and they were charging you interest and principal. So you're going to do the same thing, but it's going to be from your banking system and from your account. So you take the loan from your account, you pay for the car. Now the car is bought and paid for. But remember, when you were borrowing from their bank, the other financial institution, you were willing to pay monthly payments to them, principal and interest, for that car. So if we did that from your bank and we took the loan from your account to pay for the car, where would be the problem with making payments back to your bank? Well, there shouldn't be a problem. People stumble all the time over this. People get caught up on this all the time. They're like, I don't want to make payments back to mine. It was my money to begin with. And I agree. It was your money. You saved that money that we took out to buy the car. We indeed did. But you have to treat your money the same way you would treat their money, because we're taking the banking functions back, which means we're mimicking what a bank does. So you are going to make that exact same car payment, but you're not going to make it to their bank. You're going to make that car payment to your bank. All we did is we went in a circle. Money started in your account, moved over to their account to buy something, which in this case was a car. Then you made monthly payments like you would have anyway, but you made those monthly payments to your bank. Now, if you did just that, forget about the product. If you did just that, would you not get all the money back for every car you ever buy, drive, and own? You indeed would, because you'd be making those payments back to yourself instead of to somebody else. So therefore, all the money would end up back in the original account where the money started. So why doesn't everybody do this? Well, a couple reasons. First off, if you were listening, you had to capitalize your banking system. You had to save money to build up enough to at least pay for the car. Now, here's the funny thing. I come across people all the time that have a car that is leased or financed, and when I ask them, how much money do you have in the bank? They have more than enough money sitting in the bank that they could have paid cash for the car. So why don't they? Well, because they're actually smart. That's why. Because if they did have money in the bank and they paid cash for a car, that money that they had in the bank no longer works for them. It's lost its opportunity to earn money, because when they take it out and buy the car, that money is now in a depreciating asset called a car. That's not a smart thing to do. But you see, if you just add this process and you make the payments back to the original account, you replenish the original account with interest as well. So there's the payments you're making back include the same interest you would have paid to them. Heck, you don't even need to figure this out. Just go online and find out what banks are charging for car loans. Or go on and do the work and figure out what they would charge you for a car loan. And then make that exact same payment back to yourself. So let's put a pin in that for a second. All we did is a car, but if we did a car, what else would work? Everything. But before we go into the rest of this, I got to ask you all for a little favor, because now I just told you no matter what, how to get all the money back for every car you ever buy, drive, and own. So I'm going to ask you to do this. Click the subscribe button. And then right above, there's a little bell. Smash that bell. You can even try headbutting it. That always works. And you can even just throw something at it and smash the bell so that you're notified every time I put out new content. So let's get back to the basics. So who does this work for? Well, really, it works for almost everybody, but not everybody. Because this will not work for the folks that are not saving money, that are not practicing good financial planning for their lives. And number one rule, okay, the first law of wealth is save money. 10% of what you make. Now, you don't have to be saving 10%, but that is the law of wealth, the first law of wealth. Save 10%. So in order for this to work for you, well, you got to be saving money. Because if you're not saving money and you're living paycheck to paycheck, well, I can't help you. And this concept can't help you either. But if you are saving money, let's identify where you're saving that money. Most of you are saving in probably a brokerage account, maybe a 401k, maybe just a bank account or savings account. Hopefully it's one of those high yield savings, at least for now. All we would have to do is change where that savings goes first. This is not the final resting stop. A lot of people are like, why would I do that? What that whole life policy, how much does that pay me? Well, between 5.5% and 6%. Okay, well, I can make way more than that in the stock market, way more than that in Bitcoin, way more than that in real estate. Well, hold on a second. You're not listening to what I'm saying. We're taking back the banking functions. We're not deciding, should I put money here or there? This guy at this event I just went to, he was so hung up on that. He's like, well, I don't really get excited about 6%. I said, nor do I. I said, but I would be really excited if I could earn 6% and whatever you're earning in that real estate. 6% and what you're earning in the S&P 500 or whatever stock portfolio you have. You see, this is not this or that. This concept is this and that. You're going to make money twice now. So how does that work? Before we get into all that stuff, let's just talk about what is the minimum. Well, let's start with the maximum. So the maximum amount you could put into your private banking system is based on your, what they call, human life value. Now, that's a big word. All it is it's based on your income, your assets, and roughly, a simple way to do it is about 25 to 30% of your gross income. Total gross income. That's your max. Okay, so what's your minimum? Well, this could vary by age, but let's just keep it nice and simple. 10 times your age is a good starting place. It's not the absolute bare bones, but it's a great starting place. So 10 times your age. Some of you are thinking, well, how do I figure that out? Super easy, add a 0 after your age. I'm 47. If I add a 0 after my age, that's 470. That would be my minimum monthly savings to make this work. Fair enough? So now let's get back to that silly product that some of you were thinking, the infinite banking concept is whole life. It's whole life. That's what you always hear. And whole life is the worst place you can put your money. Well, we don't have to use whole life to do the infinite banking concept. However, if I'm going to just give you some really quick tidbits of why you might want to consider using a specially designed whole life policy. You notice how I didn't say a normal whole life? Because a normal whole life won't work all so well for this, but a specially designed whole life certainly will. So what do I mean by specially designed? Well, let's get into that. So if you take a whole life contract, they're not all created equal. It's kind of like if you saw two gray Camaros in front of you while you're waiting at the light. Are they both the exact same car? Well, some of you would say yes, but you see, what you're not seeing is one of them's got a little 4-cylinder under the hood, the other one's got a really pumped up V8, and there is a big difference between those two gray Camaros, but they look the same. But under the hood is where the difference starts. Well, when we design and engineer a whole life contract, we are doing it to put the V8 in the whole life. So we're trying to make this thing really scream from a growth standpoint. So how do you do that? Because if you ask your agent or financial advisor, they're gonna tell you, there's nothing you can do that does this. But here's how you do it. And I've got a whole video on this, but what you would do is you would find out the needs and goals of the client. So we'd find out what your needs and goals are. How much do you wanna save? So many people, when they go to buying a whole life policy, start with the death benefit. We do not. We start with the amount you want to deposit. Because remember, we're changing one thing, and that is where your savings goes. So we always start with your savings amount. So if you said to us, all right, I want to save $1,000 a month. Great. That's where we start. So then what we're going to do is we're going to go to the insurance company and the illustration software, and we're going to figure out what is the minimum amount of death benefit that the IRS requires on a rule called the MEC 7 pay rule. What is the minimum death benefit we need to support that $1,000 a month premium deposit? That doesn't sound like the way a regular life insurance is built, does it? Well, no. And not only that, it does another really cool thing, not for us, but for you, is it reduces our commission tremendously. So depending on how much we reduce the death benefit, which is based on your age and the amount of your deposit, we're gonna try to reduce it to the lowest level. Meaning we are stripping out our commission, or I like to say, we're taking less of a commission so that you have more cash value. And we support that either with a term rider if needed by IRS codes. So sometimes we do use term, okay? But we'd only use it for 7 years because that's how long we're required to have that term rider on the whole life policy to satisfy the IRS rules. The other thing we do is we take the majority of that $1,000 a month, that premium deposit, and we put it into a special rider. A special rider called a paid up additions rider. Now some companies call it something different, but paid up additions, PUA is what we call it. When we put money into that, that almost immediately goes 100% to your cash value. So now when you deposit $1,000, you could have 80 to 90% of that $1,000 available immediately when your check clears. Now it's not 100%, but it's pretty darn close in the early years. So you're still thinking, well, why is that better than a bank account? Well, let's get into that. I'm just telling you how we design and engineer the whole life differently. We reduce the death benefit, take the remaining of the amount of money you want to save and put it into that special rider, which makes it available, or at least mostly available, to you in cash value. So you're creating liquidity inside the contract and efficiency because we're reducing the fees in the contract by reducing the death benefit cost. See, that's how it's done. Again, I didn't go really deep on that, but now, you're still thinking, why would I use this whole life? Chris, get to the point. All right, remember back to the process? We changed where the money went. Now you know it goes into a specially designed whole life. But what's the next thing we did? We took a loan from the whole life, I called it your private banking system, to buy the car. Remember that? So now we took a loan. And you're thinking, but wait, Chris, it's my money. Why would I take a loan from my money? It's my money, it's not somebody else's. Well, here's why. Because if we take a loan from the insurance company, what the insurance company is doing is leaving your money in the account earning interest and dividends. And if you're making 5.5% to 6% gross on your cash value, that could be really advantageous because $1,000 a month is $12,000 a year. Imagine $12,000 earning interest and dividends, compounding at that. But then you take, let's say, $10,000 of the $12,000 out. How much is left in your account? $12,000. But wait a second. I took $10,000 of the $12,000 out. How is there $12,000 left? Because you took a loan. Where'd the loan come from, Chris? Well, it came from the general account of the insurance company. The insurance company lent you money from their general account, and really what they did is they collateralized the loan with your cash value. You have $12,000 in there, earning interest and dividends. You took $10,000. You've got enough cash value to collateralize the $10,000 loan. And here's the other thing. The insurance company doesn't ever ask you for that loan to be repaid. Because at the end of the day, what they did is they went in and made a little adjustment to your death benefit, and they put minus $10,000 loan. So if you died the next day, they would pay a death benefit minus the outstanding loan. It's brilliant. But what it also is brilliant for you because you just found a way to earn interest and dividends on a tax-free basis inside the cash value, and you found a way to use that money without interrupting the compounding growth. And then you're gonna make those payments. Remember I said you're gonna make payments of interest and principal back to the account, which the account is the whole life. Those are loan repayments. So now every payment that you're putting back into that specially designed whole life as a loan repayment is money you have available the next day because you are the bank, not them. You don't make car payments to the bank and go back and ask them for the money back, do you? No, but when you do it to your bank, you actually have the money that you can take again right after you deposit it, if you needed it. But what you're also doing is paying down the loan to the insurance company. You see, I missed something, and I bet you some of you are thinking,
oh, you forgot an important thing, Chris. That loan the insurance company gives you is not free.
You're right. They charge you simple interest on that loan. In the companies we work with right now, most of them are around 5 to 5.2%. So if you're paying 5.2%, but you're making 5.5 to 6%, what are you making? A spread. That's right. How did a bank make money when I talked about that earlier? Remember, you took your hard-earned dollars, you put them into the bank. The bank paid you, what did I say, 2%? They paid you 2% interest, but then they lent it back to you at 6 to 8%, making a spread. Well, you just found a way to make a spread, but you see, you're in control of your money. You don't lose any of the money, and not only that, when you're paying the loan down, because it's simple interest, when you pay the loan down, the interest the insurance company is charging you is going down too. Not the interest rate, but the interest volume, because you're paying interest on a lower and lower and lower balance. Because every car payment you make is paying the loan down, while your cash value continues to compound up over and over and over again. It never stops compounding because you're never affecting or interrupting the compounding effect, because you're not using your money. You're using the insurance company's money. Therefore, your money is allowed to grow and work for you 24/7. Remember I said, what is the infinite banking concept in the beginning? And I told you it's the process of taking back the banking functions in your life. We did this with just a car, but what else would it work for? Would it work for boats, houses, financing furniture, financing appliances? Anything you would ever finance, it works for. But what else does it work for? It is one of the most magical things you could ever use to pay off your debt. So if you use this to pay off your debts and recaptured the amount you're giving to Visa, Amex, Discover, and all those credit cards, how much would you be able to make? I'm gonna put a pin in that because I got a video that shows exactly how much you would make, and it will blow your mind. So as we get to the end of this video, I want to preface one thing. What is the difference between a regular whole life and a specially designed whole life that we use for the infinite banking concept? The simplest answer I could give you is a regular whole life is designed to maximize the death benefit. A specially designed whole life is designed to maximize cash value growth, which would minimize death benefit. So if you're looking for the most death benefit, this specially designed contract would not be the best choice. But if you're looking to do the infinite banking concept, to take back your banking functions in your life, well then the specially designed contract definitely serves the purpose. So that's the easiest way to say that. But with that being said, folks, one other really important thing, and now I know everybody's minds are all focused on this specially designed whole life because that's the tangible thing we just talked about. It's the thing that you know, it's the thing maybe you like, don't like, doesn't really matter, but that's the thing you're focused on. Oh, it's a whole life, it's a whole life. What did I say? It's not about the product, it's the process. You see, the most important thing to building wealth is not this dumb, specially designed whole life. So if you're not diligent with the recycle, recapture, if you're just taking loans from the whole life and buying things and not putting the money back into the policy, this is not gonna work for you. We have an entire team that works with our clients to help them implement this and hold their hand through that implementation process, because we know in the beginning, it's just a different mindset that you have to think like a bank. But again, the preface is not the whole life. What the preface is, this is banking, folks. This is privatized banking. What are we teaching? We're teaching banking 101, and we're teaching you how to be the bank. And if you have any questions or any thoughts on like how that actually looks, then you're gonna wanna check this video out right here. It's a great video that takes you through all of it, and it shows you how to pay off debt and gives you all the mathematics for getting all the money back for every car you're gonna buy, drive, and own. So check that video out. With that being said, thanks for joining us for this episode of BYOB. Go out there and be your own bank.